Hello and welcome to Kiplinger's Spotlight on Year-End Tax Planning and Charitable Giving in association with the Jewish Communal Fund, a donor-advised fund that manages $3 billion in charitable assets. My name is Sandra Block, and I'm a senior editor at Kiplinger Personal Finance magazine. I'm joined today by Joy Taylor, editor of the Kiplinger Tax Letter, and Rachel Schnoll, Chief Executive Officer of the Jewish Communal Fund. To start us off, Joy will discuss year-end tax planning with a particular focus on charitable giving. You're welcome to submit questions, which we'll try to answer via chat. We also received questions in advance, some of which we will answer at the end of this presentation. Welcome, Joy.
Hi, thanks, Sandy. So as Sandy said, I'm going to be talking for about 15 minutes or so on year-end tax planning with a focus on charitable giving. So with less than 2 months left in 2024, many people are starting to think about year-end tax planning, both opportunities to save on taxes and tax traps to avoid. On individual planning, you want to look at the overall impact on your taxes over 2 years, in this case, 2024 and 2025, with the end game is to cut your tax bill over both years. So we already know the tax rates, tax brackets, tax deductions, and credits for 2024. But what about 2025? Well, the IRS has already issued the inflationary adjustments for 2025, but will there be any other changes? Well, next year is the perfect storm for enactment of a big tax bill. First, you have a bunch of expiring tax provisions. Many of the provisions affecting individuals in Donald Trump's 2017 Tax Cuts and Jobs Act are set to expire after 2025. These include lower individual income tax rates, higher standard deductions, the larger child credit, the $10,000 limitation on deducting state and local taxes, the higher exemption for alternative minimum tax, and the much bigger lifetime estate and gift tax exemption. Some people refer to these soon to expire tax changes by such colorful names as Taxmageddon. We've heard Super Bowl of Tax, there's Tax Sunset, 2025 Tax Cliff, and actually my favorite is Taxapalooza, but that's because I'm a music lover. In addition to the expiring tax changes, you have an incoming president, Donald Trump, who's bullish on lowering taxes. And because of the November election, you have a trifecta for Republicans in that they will control the White House and both chambers of Congress. That will empower them to set the tax agenda. But there's a caveat here. We don't think they'll be able to pass everything that Trump has promised on the campaign trail. First off, Republicans will only have a very small majority in the House. Second, they will not have although they'll control the Senate, they won't have a filibuster-proof majority in the Senate. And third, probably most important, is we have a massive federal debt of nearly $36 billion and growing by the day. And we have economists have said that the 10-year extension of all the provisions in the Tax Cuts and Jobs Act could cost an addition, nearly $5 trillion more. And that's not including everything that Donald Trump has promised in addition to that. So although we think that there will be a tax bill that's passed next year, we don't yet know everything that's going into it. And there's going to have to be some compromises, possibly some revenue offsets, et cetera. Also, it seems to us that in that tax bill that we expect to pass next year, the most sensible thing would be to have most of those tax changes take place on a prospective basis beginning in 2026 and not be retroactive to 2025. This timing makes the most sense to us because of the expiration, the 2025 expiration of the 2017 tax law. Although maybe there might be some tax cuts that are made retroactive. So that's a long way to say that when considering the overall impact for 2024 and 2025 on your taxes, we're going to assume here that the tax rules for 2025 will be similar to that of 2024. So charitable giving is a very important area of year-end tax planning. And there's lots to talk about here. I could go on all day, but in the essence of time, I'm going to keep this brief. So let's first start with an aspect of tax planning through charitable giving that applies to generally to retirees who own traditional IRAs. If you're if you're age 70 and a half or older, the tax laws allow you to transfer up to $105,000 this year from your IRA directly to charity. These so-called qualified charitable distributions, or QCDs, can count as all a part of your required minimum distributions, but they're not taxable and they're not added to your adjusted gross income. The QCD strategy is a good way to get tax savings, for example, from charitable gifts for taxpayers who are taking the standard deduction instead of itemizing on their tax return. It's also good for people who want to keep their adjusted gross income level low. For example, if they want to avoid higher Part B and Part D Medicare premium surcharges. Your tax returns, your 2024 return will be, the adjusted gross income on your 2024 return is going to be looked at by Medicare officials to determine whether you are subject to these higher Medicare premium surcharges in 2026. There's a few other important points to note about QCDs. First off, if you're doing one of these qualified charitable distributions, you cannot also take the deduction for the contribution on Schedule A of your return. That would be considered double dipping. Second, qualified charitable distributions can only go generally to operating 501c3 charities. There's a limited rule that allows a one-time QCD of, I think it's $53,000 in 2024, a charitable remainder trust or a qualified or charitable gift annuity. But unfortunately, you cannot do a QCD to a donor advised fund. Second, QCDs can only be made from your your IRA. So you cannot do a QCD through a 401k, a government thrift savings plan, or other workplace retirement plan. Another point to consider is if you want the QCD to count as all a part of your required minimum distributions, then you want to do the QCD in the year before you took the distributions. Like, for example, if you've taken all of your RMD already for the year, you can still do a QCD and it will be non-taxable to you, but it will not offset those RMDs. Fifth or fourth, there's a complex rule for people that are still working and making deductible contributions to their IRAs after 70 and a half. Essentially, those post 70 and a half deductible IRA donation or contributions, essentially, they reduce your allowable tax-free QCD amount until they're used up. And for people wanting to learn more about qualified charitable distributions, you can look at IRS publication 590-B. You can go to IRS's website, or you can just Google it. Pages 13 through 15 have more information on QCDs. We have written a lot at Kiplinger on qualified charitable distributions. There are some online stories on those. And also, I think IRS's publication on charitable contributions might have some information on QCDs. So on year-end tax planning, most people will benefit by accelerating deductions from 2025 into 2024. That's not everyone. For example, if you have large if you have a large income windfall or capital gain next year, you'll want to do the opposite and try and defer your deductions from 2024 into 2025. Itemizers who claim charitable contributions on Schedule A of their 1040s have the most flexibility in shifting tax write-offs. For example, they can bunch into 2024 charitable gifts that they usually gift over multiple years. Donating appreciated property to a charity can get you the most tax bang for your buck. If you've owned the property for over a year, you can deduct its full value in most cases if you itemize, and neither you nor the charity have to pay tax on the inherent gain. Conversely, you don't want to donate assets that have lost or that have dropped in value. If you do that, the capital loss is gone forever, and neither you nor the charity will get the benefit of it. And here's a tip I think many people aren't aware of. Essentially, if you incur out-of-pocket expenses for charitable work, you can deduct those on Schedule A. Like, for example, my mother-in-law every year buys poinsettias for her church's holiday service. If she itemizes on Schedule A, she can deduct the cost of those poinsettias. Also, if you volunteer for charity, you can deduct 14 cents a mile for charitable driving. There are some important rules or limitations to keep in mind if you are someone who donates lots of your income to charity. Cash contributions are deductible in a year only to the extent that your total cash contributions don't exceed 60% of your adjusted gross income. And the adjusted gross income limit for donations of capital gains properties, such as stocks, bonds, shares, and mutual funds, is generally 30%. Now, the excess contributions aren't lost. You can carry them forward for 5 years. So note that the 60% adjusted gross income limit for cash contributions is one of the provisions scheduled to expire after 2025. So unless Congress acts, this limit is slated to decrease to 50%, which it was in years prior to 2018. It's sort of too soon to tell what Congress will do with the 60% AGI limit when they work on the tax bill next year. They might reduce it back to 50%. They might keep it at 60%, or they might, decide to raise it. In fact, Congress actually did raise it to 100% temporarily during the height of COVID, but then they dropped it down back to 60%. So donating to a donor-advised fund is a tax-advantageous way to bunch your donations into 1 year. Donor-advised funds are 501c3 exempt organizations. Whether you contribute cash, securities, or other assets to a donor-advised fund, you can generally take an immediate charitable contribution in the year of the transfer, subject to the 30% or 60% adjusted gross income limits that I just talked about. The transferred assets or money are invested in an account with a donor-advised fund with tax-free appreciation. You can then advise, the donor-advised fund to make grants of the money to specific charities. And the grants to the charity don't have to be made in the same year that you donate the funds to the donor-advised fund. Also, IRS has no mandated limits on how much a person can contribute to a donor-advised fund in a year, although I know certain donor-advised funds have certain floors. I don't know, but I don't think that they have caps. And an important point to note that contributions to a donor-advised fund are irrevocable and cannot be taken back once gifted to the fund. It's somewhat similar, like if you decide to make a donation to the American Red Cross, you can't then ask the American Red Cross a couple months later for your donation back. And that's the same with the donor-advised fund. So let's illustrate this with a simple example. Say you have stock in a publicly held company that's worth $20,000 that you bought years ago for $5,000. If you donate the stock to a donor-advised fund, you can claim a charitable deduction of $20,000 on Schedule A for the year of the donation, subject to the 30% of adjusted gross income limit. Neither you nor the charity will pay tax on the $15,000 inherent or unrealized gain in that stock. Essentially, it disappears. So you now have an account with a donor-advised fund of $20,000. Let's say you want that conservatively invested. The income gain earned in that account isn't taxed, but instead grows tax-free so that more money can be given to the charities that you choose over time. So I'll now turn it over to Sandy and Rachel to speak more on the ins and outs of donor-advised funds and how they can be part of your overall philanthropy strategy. Sandy, Rachel?
Thank you, Joy. Now that Joy's gone over how donor-advised funds could be part of your year-end tax planning strategies, Rachel and I will talk about how these funds could be part of your long-term charitable giving strategy. So, Rachel, to start, could you talk about the types of people who contribute to donor-advised funds and why they find them attractive?
Sure. So thanks so much for having me. So there's a joke that I've heard about if you've met one wealthy person, you've met one wealthy person. And I would say the same thing about donor advised fund holders. The wonderful thing about donor advised funds is that they provide so much ease, simplicity, and tax benefits for everyone who uses them, regardless of where you fall on the wealth spectrum. A lot of people like to use the word democratizing philanthropic giving, and I feel like that word is used a lot, but it is really true about donor advised funds. They do democratize giving for anybody who's inclined towards philanthropy. At the Jewish Communal Fund, about half of our funds actually have a balance of less than $25,000. So that really represents, funds for everyday people. They're benefiting from the tax benefits, but more than that, they're benefiting from the ease in which ADAPT provides. The fact that all donations can be made from one online portal rather than going to multiple websites for different charities, using a credit card, which often has fees, which means less money to a charity, or writing physical checks, which who wants to write physical checks anymore? So donor advised funds make giving very, very simple, accessible, and flexible. On the other end of the spectrum are very high net worth, ultra high net worth people. We at Jewish Communal Fund work with many family offices who find donor advised funds a convenient way to conduct their philanthropic work. And they may use a donor advised fund either in place of or in addition to a foundation. So donor advised funds take care of all the administration work and also provide a level of privacy that a foundation does not offer. So, for example, if you are a family and you have a foundation, everything that you do in that foundation is public information because every year you have to file a 990 with the IRS. In that 990, you include the total assets of the foundation, how those assets are invested, if anybody in the family makes a salary off of that foundation, where and how much that foundation gives to every charity that it supports. And there's many fundraising databases that mine that data and make it very easy for other people to find. If a family uses a donor advised fund, all of that information is private. No one knows how much is in your donor advised fund, how you invest that money, or where and how much you give. You can also choose to make your donations anonymously with no disclosure, or you can make them with attribution. And it's an interesting fact is that at the Jewish Communal Fund and really industry-wide, over 90% of donations that are made out of DAFs are actually with attribution. So it's a myth that donor advised funds have people giving anonymously. So donor advised funds really benefit all kinds of people that have a propensity for charitable giving across the wealth spectrum. I'd also like to note that there's benefits for charities when individuals use a donor advised fund. So donor advised funds, like Jewish Communal Fund, there's no cost to the charity to receive that grant. So unlike a credit card, which I mentioned earlier, if I go to American Red Cross, the example that Joy used, and I enter a gift on their website and I use my credit card, there's anywhere from a 2 to 4% fee for that gift. And I either have to up my gift to cover that, or the charity receives less money. When you receive a grant from a donor advised fund, there's no additional cost for that charity. Also, if you're writing checks to a charity, then it's burdensome for that charity to sort of get all the checks and cash them and record them. Many donor advised funds, including Jewish Communal Fund, is sending more and more of our grants out electronically. So if our fund holders send 100 grants in a day to the United Way is going to receive one deposit in their bank account from the Jewish Communal Fund that day, and with all the information identified electronically. So it makes it really, really easy for the charity.
Thanks, Rachel. I'm glad you brought up sort of the comparison to family foundations, because one of the aspects of donor advised funds that has always appealed to me is that parents and grandparents can use them to teach their children about philanthropy. Have you seen this among the donors to your fund?
Yeah, absolutely. And I'll talk about a few different ways that I see families using donor advised funds to really communicate about philanthropy and the importance of helping others. And because donor advised funds, as we've already discussed, are so simple and easy and flexible, there's a lot of different ways that families use the vehicle to promote giving within the family. So let's start with families of young children. So for families of young children, we see conversations about philanthropy take place around the holidays. We've got them coming up really soon. We're a Jewish donor advised fund, so I'm going to use Hanukkah as an example. So there are 8 nights of Hanukkah. And many families pick one night and say, well, kids, instead of getting a gift, a physical or material gift tonight, we're going to make a family donation, and let's get together and have a conversation about what kind of cause we want to support. Do we want to support, animal welfare? Do we want to do something for the environment? Do we want to do something for a local religious institution or a local community center? And so it really is a great way for the family to talk about causes that are near and dear to them, and also to the kids. Like, as a parent, sometimes when your child brings something up, you didn't even know that was on their mind, and they want to support something that you had no idea that they had an interest in. And so it's such a wonderful way to learn more about your kids. And then you might make that gift, from the family on that night. And a donor advised fund is a great way to make one of those gifts. For other families, philanthropy is not just doesn't just happen at the holidays. It's an all-year conversation. And those families may start to choose a family DAF. Many of the donor advised funds at the Jewish Communal Fund are called, like, the Schnall Family Donor Advised Fund. And we're very flexible in the way we work with families to allow the whole family to participate in the philanthropy. So one way that a family can do this is just have conversations similar to what I mentioned around the holidays, and say what causes they want to support, and then the parent could enter the grant and make the donation to the organization. We can also empower other people in the family to make grants on their own. So if I have a teenage child, for example, and that child is really interested in animal welfare and wants to support the local cat and dog shelter, they could go into the donor advised fund, enter that grant, but then the parent might need to approve. So we can set up a fund that way. The other way that we can do it is if the family feels really confident about their children's decisions, the parents can actually say, we're going to allow our child to go in and make a grant and we don't have to approve it. So there's a lot of flexibility that gives kids the ability to participate in philanthropy. As we move up the age spectrum where you have, older teens or young adults, you can actually set up a donor advised fund for that child. I just did this. My daughter graduated from college in May, and part of her graduation gift, my husband and I gave her a donor advised fund. We transferred assets from our donor advised fund, intra-fund transfers that went up in her name. And now she has a lot of agency with her philanthropic decisions. So if she wants to support her college or the high school she went to, she can do that 100% on her own with the funds that are in that donor advised fund. If she wants to talk to us about it, we're there for her. But I really like the idea of getting her started on her philanthropic journey on her own. And then I'm hoping that as she continues to earn an income, that she will contribute additional dollars to her donor advised fund as well. And then my last example has to do with grown children of wealthy families. And Sandra, I'm going to come back to foundations. So sometimes families of very high net worth families have established foundations. And the belief is that by having this foundation, it's going to keep the younger generations engaged in the family philanthropy. And in many cases, the founder or the founding generation has particular causes that they care about, and they want to keep the next generation engaged in those causes. And however, what we're finding, and not just at Jewish Communal Fund, but more broadly in philanthropic circles, what we're finding is that many individuals in the next generation don't necessarily share the same philanthropic causes as the previous generation, and they kind of bristle at this forced familial collaboration around philanthropy. And a donor advised fund is a great way that the foundation can give, again, that agency that I talked about. So you could, a foundation could start donor advised funds for different members of the next generation, so they do have some freedom with their giving, so that maybe they don't feel as stifled as only being able to contribute through that family foundation. And the family can still continue their philanthropic legacy, but again, with a little more agency. So those are a few different ways that I see families really getting together around philanthropy and using DAFs and the flexibility that DAFs afford to help them.
That's great, Rachel, and I think that's such a lovely idea what you did for your daughter, because a lot of people starting out want to donate to charity but can't afford to do it. So I think that's a really interesting graduation gift. I guess my last question before we start switch to some questions from people who registered in advance is, and this sort of relates to families, is how do donor advised funds fit into your estate planning, and can you discuss how they play a role in planning your estate?
Sure. So Joy already alluded to this a little bit. Donor advised funds can be a really important tool in estate planning. So one of the terms that's set to expire with the expiration of the Tax Cuts and Jobs Acts is the Unified Estate and Gift Tax Credit, which is currently a little more than 13.6 million and is scheduled to automatically reduce to 7 million. So a donor advised fund, any assets that are in a donor advised fund are not included in your estate. So you can actually minimize the amount in your estate while still being very generous to the causes that you care about. If you set up donor advised funds for others in your family, like I talked about that I did for my daughter, that does not count towards your gift tax credit. So it's a great way to pass down the gift of giving. And the Jewish Communal Fund is very flexible about what donors can do with their fund after their lifetime. So we encourage every fund holder to have successors. So those are the people who will be in control of the fund after that person's lifetime. So we see successors can be most frequently family members, maybe children, but they can also be trusted friends. They can be advisors, financial or legal advisors, or they can be charities. So you don't have to leave it to an individual. You can leave the dollars in your donor advised fund to a charity. And there's no limit at Jewish Communal Fund to the number of generations in which a fund can be passed down. So the Jewish Communal Fund was founded in 1972, and some funds that were founded that year are now in the hands of the third generation of that same family. So really very philanthropic legacies that are being passed down from generation to generation. And deaths can be a really good way to leave a philanthropic legacy outside of the family too. So Jewish Communal Fund and many other DAFs allow you to set up a legacy or endowment fund. So that means that you can leave money that's currently in your DAF, or you can leave money that is you can make a gift from your will. And then you can work with JCF or your DAF to identify the charities and the amount of dollars that you'd like to grant to these charities after your lifetime. So let's say I have $1 million donor advised fund, and every year I want to take 10% of that. I'm going to leave it in the DAF. I'm going to keep it invested in the DAF. And every year I'm going to take 10% of whatever the corpus is and give it out to 10 charities. The Jewish Communal Fund would administer your wishes for you, and many DAFs will do that for you. From a financial planning standpoint, there's a number of ways that we see individuals fund their DAFs from their estate plan. So one way is an outright bequest in their will. Other people leave the residual of their estate to a donor advised fund. One of the smartest things I see is make the donor advised fund a beneficiary of your IRA. It's a very fast process. It's outside of probate, and it unburdens your heirs from needing to take the taxable distributions that an IRA is going to bestow in their lifetime. And that can also be administratively burdensome. So it's really nice if you want to pass on a philanthropic legacy to do that by just making the DAF the beneficiary of an IRA. Super easy thing to do. You can also do that from life insurance or a charitable trust. So we see people doing that a lot. So there's a lot, like everything I've been talking about, there's a lot of flexibility that donor advised funds offer with estate planning.
Great, thank you, Rachel. Now we're going to answer some questions that were submitted in advance by folks who registered for this webinar, and I'm going to direct them to both Rachel and Joy. So let's start. I'll start with this question for you, Rachel. Can you control where donor advised funds go year after year, and can you decide each year where to spend your money?
Sure. So I like to say that donor advised funds are called donor advised for two reasons. One, the fund holder can advise on how those funds are invested. So when you make a contribution to a donor advised fund, that donor advised fund is generally going to have a number of investment options, and the donor can select what investment options they want to pick. So it's kind of like a 401k that way. The second thing that the donor advises on is where the grants get made or the gifts out to the charities. And Jewish Communal Fund and many other DAFs have a simple electronic portal or web portal that you can make those grants. There's a few rules about where those grants can go. They're not too onerous. The grants can only go to 501c3s that are in good standing with the IRS, so it can only go to charities. And they can't be used for things that have any kind of ascribed value, like a museum membership where you get free admission to the museum, or the registration fee for a charity bike ride. Even though it's for charity, it's the registration fee has a value, or buying a table at a gala, at a charitable gala. Can't use the donor advised fund assets for that.
Okay. All right. This next question is for Joy. a participant would like to know how they can use charitable giving to reduce taxes on a withdrawal from a 401k or a thrift savings plan.
Okay, that's a great question. Unfortunately, you cannot do a qualified charitable distribution from your 401k or thrift savings plan to a charity. As I said, I mean, I would normally say do a qualified charitable distribution, but those are only available to be done through IRAs. So the other way is to just, look into, don't look into charities you want to donate to, bunch your deductions over multiple years into, if over multiple years into 2024. Look into, donating to a donor advised fund to get the most bang for your buck. And if you want to get it even more, look into donating, securities, stock you own, shares in a mutual fund, things like that to a donor advised fund. But yeah, those are some of my suggestions.
Okay, thanks, Joy. Rachel, this question, and I think this is something where donor advised funds can play a role. How can I best choose the most worthy charities for donations? I think a lot of donor advised funds do provide some guidance on that sort of thing. Can you talk about that?
Sure. So that's something that, people want to make sure that they're giving to charities that are going to use the money wisely. And there's some public resources that are available for that. There's one called Charity Navigator. There's one called GuideStar. Jewish Communal Fund and many other donor advised funds will talk to our fund holders about where we're seeing dollars go and what we know are worthy charities in certain areas. There's also, if you are really trying to plan a philanthropic strategy, there's a whole industry of philanthropic consultants, and they work across different wealth levels. And a philanthropic consultant can actually help you craft, if you're really trying to attack a certain problem in the world. They can talk to you about charities that are, worthy charities in that sector. And you can actually use dollars in your donor advised fund to pay for that philanthropic consultant. So that's something that people may not know.
Okay, thank you. Joy, this is for you. This individual expects to have a substantial capital gain in January 2025. They want to know what they should be doing now, if anything, I guess, to manage taxes on that gain.
Yeah. So if you guys remember, I had said during my discussion that most people would want to accelerate deductions from 2025 into 2024, but not everyone. And here's a case where you have a not everyone. So this person who's going to have who's going to have a big capital gain in 2025 will want to do, I think, the opposite. They'll want to, bunch charitable contributions into 2025 instead of 2024. They'll want to accelerate any deductions that they can take to 2025 when they're going to have this big windfall. Another thing they can do, and many of you might have heard about this, is what's called tax loss harvesting. Normally you'd wait until sort of closer to year end. You'd look through your taxable accounts, see where you have losers that you might want to sell, and think about selling those losers before year end to be able to offset that capital gain. Obviously, you don't want to do anything just for tax purposes. So if you think, for example, those losers will eventually go back up in value, I'm not saying to sell them, but if you're otherwise thinking of selling some losers, that's another way to be able to offset some of that capital gain.
Okay, another question for you, Joy. This individual is planning to make a gift to a relative, I guess, instead of to a charity. How do they report that for tax purposes, if at all?
Okay, yeah. So So surprisingly, the taxation of gifts, even though I find it to be quite simple because I'm a tax expert, I think many people are a little bit confused on this. So if you make a gift, say to a relative or a person other than a charity, say you make a gift, you can't deduct that gift, and the gift is not taxable to the recipient. Okay. Um, and if your gift is to any particular donee, if the total amount of your gifts in a year is less than what's called the gift tax exclusion amount, for 2024, it's 18,000, it's 19,000 in 2025, then you don't even have to report those gifts to the IRS. So for gifts, however, for more substantial gifts to a particular donee, let's say you donate, $25,000, or not donate, you give $25,000 to your son. You will have to report that gift on Form 709. So you'll have to file a gift tax return on IRS Form 709. But you'll most likely not have to pay any gift tax on it unless your total lifetime gifts has exceeded the lifetime estate and gift tax exemption, which Rachel mentioned is about 13.6 million for 2024. So although you'd have to file Form 709 on gifts over 18,000 to a particular donee, you will not have to, in most cases, pay gift tax on that.
Good to know. Rachel, this question is for you, and we did sort of hit on this. Joy talked a little bit about the expiring tax breaks in the Tax Cuts and Jobs Act, and I know this is something everyone involved in philanthropy is paying attention to. What do you think the expiring tax breaks will have the most impact on charitable giving this year and in 2025? Are you seeing people sort of respond to this in any way?
I'm not seeing people respond yet. What I think the biggest response we're going to see this year has nothing to do with the Tax Cuts and Jobs Act, but the fact that the market's been really, really strong this year. We're going to see a lot of people donate appreciated securities for the reasons that Joy mentioned. They will not have to pay capital gains taxes on those appreciated securities, and they get the deduction of the market value of those securities on the date that they make that donation. So that's a really good strategy, philanthropic strategy for this year. In terms of things in the TCJA that may impact charitable giving, the one that Joy just mentioned, the fact that the estate tax credit is 13.6 million today and going down to 7. People may want to minimize the size of their estates and maximize their philanthropic impact, and certainly giving more to charity helps minimize your estate. The other thing, I haven't seen this yet, but people may decide to give more cash gifts because the higher tax deductibility. I think Joy mentioned this early on in the call. We just don't know where the Trump administration and the Senate and Congress is going to go on this. Like, it could be they could bring it up to a higher level, in which case you don't need to make more cash gifts this year if they're going to make 100% of your AGI, deductible. So I think people are waiting to see till we have a little more information. Another one that I think Joy touched on is the standard deduction. So the TCJA increased the standard deduction so that a smaller amount of taxpayers itemize than previously. So if that was to go back down again and more people had to itemize, you might see more people making philanthropic contributions. But I think, really, I want to give people the benefit of the doubt. People are philanthropic because they want to be philanthropic. They want to help their community. They want to make a difference in the world. And what I find is that people who are philanthropic are going to be philanthropic, and the tax benefits are an added bonus, but it may not drive philanthropy as much as we think.
Okay, thank you, Rachel. And sort of to follow up, because you mentioned people, and I've seen this, and when the market has a good year, a lot of times people do donate appreciated securities to donor advised funds. I'm curious about what other types of assets you see donated besides cash and securities, and specifically, are you seeing a rise in donation of cryptocurrency or other digital assets?
Right. Yeah, that's a really good question. So there's really four categories of assets that we see donated to the Jewish Communal Fund, and I think most other donor advised funds will have a similar experience. So cash is the most frequent gift that we receive. Followed by appreciated securities, and that could be stocks, bonds, ETFs, mutual funds. They all benefit from the you don't pay the cap gains, and you get the market. You get to deduct the market value on the day of the donation. The third category is private assets. So private assets can be shares in a private business, private equity, hedge funds. And, the private business, so many people in this country are business owners. And this is a really great way to, if you have a liquidity event that is coming in your business, donating shares in that private business to a donor advised fund is a really great way to be very tax savvy, because just like an appreciated security, you don't pay capital gains, and then you also take you get a tax deduction of the valuation of those assets. I'm going to circle back to the valuation in a minute. And when you have the liquidity event, you could actually have a sizable philanthropic asset base. So I see a lot of our fund holders make donations to the Jewish Communal Fund of private assets. The thing you have to keep in mind with private assets is when donating private assets is that there are additional expenses around it. So there are some legal costs, and then also the donor is responsible for getting an independent valuation of that asset. And you can't use philanthropic dollars. You can't use dollars from your donor advised fund to get that valuation, and that valuation can be expensive. So if you're thinking of donating private assets, you should definitely talk to your tax advisor and your donor advised fund, but it's a great way to be philanthropic. And then the last category is real assets. And real assets are things like real estate, art, and I'm going to put crypto in. I think we could argue about whether crypto is a real asset or not, but I'm going to just put it in that bucket. So let's talk about crypto since you asked about it, Sandra. So we do see crypto being donated, not in massive quantities. But we will accept, we and many other donor advised funds will accept crypto. We want more mainstream coins that we can sell on, in a marketplace like a Coinbase. And donors, though, should be aware that they do need to get a valuation on that donation of cryptocurrency that they need to file with the IRS. So that might be an added administrative hurdle that they didn't know they needed to do. But if you want the deduction, you have to get that valuation. Real estate is another, I think Joy talked about that earlier. You can donate appreciated property. Art and jewelry gets a little more difficult. There's an IRS rule that to receive a fair market deduction for a donation of art, that art needs to be donated to a public charity or a private operating foundation that is going to use that art for related use. So a museum, you could donate a piece of art to a museum that's going to then show the artwork. But if you donate it to a donor advised fund, you're going to receive, your deduction is going to be for cost basis or current market value, whichever is less. So you want to be careful when donating art. People also occasionally ask us about donating gold, and there's really no tax benefits to donating precious metals. So donating any asset beyond cash and public securities can be a little more complicated. So it can be very tax savvy, as I mentioned, but I would encourage donors to speak with their tax advisors before making a contribution of anything more complicated than cash and marketable securities to a donor advised fund.
Okay, Rachel, that sort of leads up to our last question from one of the participants, and I think you may have answered this when you said you might need to talk to a tax professional. But the tax code and the IRS have lots of record-keeping rules that donors must follow to substantiate charitable deductions claimed on their tax returns. This individual would like to know, what does the Jewish Communal Fund do to help donors comply with these rules?
Sure. So every donation that we receive, the donor will receive an acknowledgement letter, which mentions if it's cash, the amount of the cash that was received, or if it was securities, the number of shares that were received. So it's important for donors to understand that the burden of establishing the price of the shares that were sold is actually their responsibility, not the and so the guidance that we give them is that you take the average price on the day that we receive those securities. So if we receive the securities today and the average price today was $100 and you gave us 10 shares, then you could take a deduction of $1,000. Another thing to note, at least the rule at the Jewish Communal Fund, is we must, if you want to take a deduction in the calendar year, then we must receive that donation by 12/31. That means if you're sending us a check, it has to be postmarked by 12/31.
Good advice, because it's coming up pretty fast. Well, thank you, Rachel. This was great information. We're going to wrap this up, and I want to thank everyone for joining us. You can learn more about how to subscribe to the Kiplinger Tax Letter and Kiplinger Personal Finance Magazine at www.kiplinger.com. For more information about the Jewish Communal Fund, go to www.jcfny.org. A replay of this webinar will be available tomorrow on kiplinger.com. Thank you.
Thanks so much, Sandra.